up front by explaining why it's so special. Because anyone can say they're giving you something special, but unless they demonstrate why, it's just empty words and marketing talk. So let me first show you why. I'm not going to talk just a bunch of empty words. Instead, I'm going to show you directly. Okay, so let's run the tape and you can see for yourself.
We founded SMB Capital in 2006, and the goal from day one was to build the best proprietary trading firm on the street. We set up shop here in New York City, and the idea, both from my partner Mike Bellafiore and myself had, was we really needed to build a comprehensive training program to deal with the complexity of the markets today. Things had changed quite a bit since we began our careers, and so we'd already been trading more than a decade when we started the firm. And the idea was spend quite a bit of time and resources building up this comprehensive training program. And that's become our reputation over the years is SMB has the most comprehensive training. And that's our background. After college, both of us went to graduate school, and we firmly believe in the skills that you can develop through education and practice. And so when traders come into the firm, and I think we have about 40 traders on our desk now, trading on site as well as many on a remote basis around the country and some even in other countries. They are given comprehensive training from day one and then practical training once they begin trading our capital live. And we are also a team structure, meaning the most successful traders on our desk, who will also become good mentors and coaches, will lead teams. And by the time they become a team leader, they've been trading for 3 or 4 years. They're 7-figure traders, meaning they're making over $1 million a year. And what we're seeing from the most successful traders on our desk is not only these high levels of P&L production, but a level of consistency. And so it would be typical for the senior guys on the desk to making tens of thousands of dollars a day, but rarely to see them lose that much money in a day. And that really comes down to, from day one, the best practices and habits that we teach them to develop, as well as the trading strategies, are designed to have very high risk reward.
All right, so as you just saw, we are not some trading or investing education company that just throws labels out there like professional traders. Okay, there are many of those, and I'm sure you've seen them out there. But let me ask you, how many can show you an entire trading floor full of professional traders in the heart of Wall Street? And the answer is literally none. Because the fact is that they might have nice looking offices as a company and a great professional looking website, but their main business is not trading the markets. And sometimes that's not even their business at all. All right. Their main business, by and large, is selling, trading, and investing education. Okay. While our main business, by contrast, is trading. If we don't make money from the markets, we don't survive as a firm. If our traders don't make money, they don't get paid. So it's imperative for us to have very robust strategies that stand the test of time in real world markets. Okay, but that's not the case for all the trading investment education companies out there. And yet, let's think about this for a second. How can you legitimately teach people how to invest and trade the markets without really doing it profitably yourself for an extended period? How do you really ensure that what you're teaching actually works in real world complex markets? And the answer is clearly that you can't. And if you are someone who wants to trade or invest in the markets, and you want to have a fighting chance to actually make some real money at it and keep that money that you earn, do you really want to be learning from someone that's teaching you theory without having their butt on the line day in and day out, living and dying by the very strategies that they teach you? I sure know that I wouldn't, right? And the same would apply to any other logical person. But the good news here is that for the first time, you don't have to worry about this issue. Okay, for the first time, you can know that what you're being taught is the real deal. It's the exact same stuff being used by a Wall Street proprietary trading firm that has stood the test of time. Right. And now, one quick note I just want to make before I move on is that you might have noticed that most of our traders on the desk look pretty young when you were watching that video. So you might be wondering, well, is that a requirement to make it in this business? And the answer is not at all. Okay. Most of the traders you saw in the video are our active stock day traders that basically eat, sleep, and breathe the markets. Okay. And the good news is that our options desk is not like that at all, because with most options income trading strategies, what this workshop is all about, you're basically going to need about maybe 10 to 15 minutes a day to monitor and adjust the positions. Okay, so our options traders, because of that, the nature of the strategies, typically share a very different demographic than our active stock day traders, and they're generally in their 40s to 60s. Of course, we have a couple of younger ones, but that's the general demographic. Okay, so don't worry, age is not at all a barrier with this kind of trading investing, because it doesn't require huge amounts of energy and concentration like active day trading does. Okay. But the idea is that what you're about to learn is traded with sizable capital backed by a highly successful Wall Street trading firm. So it doesn't really get much better than that for you as an independent trader or investor. In fact, it's actually pretty unprecedented. Okay. And if you've ever bought a course on options trading or any kind of trading or investing, in fact, you naturally assume that you were learning from a pro. After all, they called themselves a professional trader and they had professional looking websites. And how are you supposed to know the difference? But the truth of the matter is that the vast majority of trading educators are not true professionals with years of consistent profitability. They just aren't, and we know that because we know the industry inside and out. Okay, the truth is that many have never even actually traded real money accounts, and most who have certainly have not been consistently profitable year in, year out. Okay, no matter how legitimate their websites make them seem. So, unfortunately, much of what's being taught out there to the public are strategies without a long term edge. Okay, and this is a very important point that really needs to be reiterated. You are being sent out to get slaughtered by real world markets when you learn from most trading investing education companies, or follow those kind of newsletters. Okay, and this is especially true in the options space, where strategies with huge amounts of blow up risk are getting sold as low risk ways to make money. Okay, and they might do so for a short period of time, but inevitably they end up blowing up your whole trading or investment account. Okay, and if you had experienced the incredible success that you were promised by all these different so-called professional companies, you wouldn't be here right now. Okay, and so if you have been trying to trade or invest your money for any significant period of time, I know you've experienced all this kind of thing that I'm talking about. Okay, you've listened to that tip by your broker and you've gotten hammered. You've heard the talking heads on CNBC talk up a stock, all day long, only to watch it lose, and you end up losing thousands of dollars when you enter it. You've seen these big Wall Street guys making millions and giving you great hope that you can do the same if only you could figure out this, the stock market game that everyone makes out to seem so simple and easy. And yet, that's likely caused you nothing but losses and frustration. And then when you went out to learn from the so called pros, when you finally decided, hey, I'm going to invest in my education, you spent a tremendous amount of money and a tremendous amount of time only basically to experience the same disappointing results. Okay. And so you naturally feel confused and overwhelmed, not knowing who to trust and what strategies are legitimate. And, that's normal. That's how 95% of independent traders and investors feel, whether they're trying to make it full time or they're just trying to make a good side income, or, they're trying to grow their investment portfolio. Okay. And the stark reality is nothing but frustration, losses, and dash hopes. And, we're not going to sugarcoat that. But again, what's different this time, okay, what's different here is that for the first time, you will be learning directly from a Wall Street proprietary trading firm. And this is not something that, independent traders or investors almost ever get access to. And so, to give you a little bit more of a background on our firm, SMB Capital is a proprietary trading desk in New York City, in Midtown Manhattan to be specific. And our firm's founders have been actively trading the markets since 1997. Now, this is not some giant Wall Street corporation. Okay, it's a firm that was built from the ground up by two traders through sheer hard work and dedication. And because of that, they didn't want to follow the old secretive Wall Street model of catering for the elite. They actually wanted to democratize the knowledge and bridge the gap between the world of the pros and the public. They wanted to do something very, very unique. Okay. And in doing so, they knew that there would be a major benefit of potentially attracting trading talent to the firm. Because of all the people that learned their methods and became profitable, some would naturally reach out and want to make trading their profession, and the firm could hire them to trade in house, adding to the pool of talent and greatly benefiting the company. So it was a great win-win, and in fact, it has turned out to be exactly the case. That bet has panned out, and as a firm, we've hired quite a few independent traders just from the public, where usually those people would never have a shot at Wall Street, and there's some huge talent in that pool because now you're targeting the entire world instead of some elite camp just in the Ivy League schools, right? And so SMB was actually launched back in 2005 with this kind of premise of bridging the world of the pros and the public, of letting go of the whole old secretive Wall Street model. And because of that, it has been growing steadily through many different markets, making us one of the most successful and lasting proprietary trading firms on Wall Street and even globally. Okay, the reality is that there are not many professional trading firms that survive and thrive for over a decade. In fact, on Wall Street, there's actually currently only a handful, just a few. With the number of firms that have gone bust after, just a few years, numbering literally in the hundreds. So very, very few, last and stick around. And so, what's instantly clear is that if you have survived and thrived as a firm, you must have some robust strategies with a very strong market edge that can be profitable in all kinds of market environments and volatility regimes. Okay. And in this workshop, you're going to be learning directly from one of our pro options traders. In fact, he is the man that heads our options desk. Okay, so right off the bat, and possibly for the first time ever, you know that you're going to be learning from a true professional who trades Wall Street firm capital and who actually manages a whole desk of traders. Okay, and it's basically one of the most successful Wall Street firms at that, where he's managing this trading desk. And so if you've always wondered how the Wall Street guys trade, you've watched those movies and you've read the articles and you've seen all the millions they make, and if you've thought that they have a secret edge that's not available to the little guys trading their own accounts independently, then you are about to be in on that secret. Okay. Now, just to give you a little more background, our firm has been featured in the highly popular television series Wall Street Warriors. And our traders are regularly featured on numerous financial networks like CNBC and Bloomberg TV. Also, quite a few of our traders are seven-figure a year traders, meaning they make more than $1 million a year each in trading profits. And so this is the pro leagues here that we are talking about. Okay. And you cannot possibly hope to compete in the markets without doing some form of what the pros are doing. Okay, or because you are competing against them, so you got to be doing something of what they're doing. And thankfully, when it comes to options trading, the strategies are much more systematic and teachable. Okay, they don't rely on elite talent and skill like active day trading does. So you can learn them directly regardless of your experience level or age, because they are very systematic and rules based like that. So technically, anyone can learn them. Okay. So, having said that, what are you going to learn exactly in this workshop? Well, first of all, the main theme of what you'll be learning is options income trading. Now, what this means for those of you who don't know is a very high probability style of trading that does not require you to figure out market direction to make money. Essentially, you get to earn money regardless of what the market does, with the exception of a limited number of unusual scenarios. And maybe for a lot of you, you didn't even know this was possible, to basically be able to earn high level income in a high probability manner without having a clue what the market does, and the market could go up, down, or sideways, and you can still make money. All right, and this is the beauty of this. So you're gonna love this if you've never heard of this type of trading. Okay, and so you basically end up making money very consistently. And if you know how to control your risk, which is obviously something we take very seriously and know how to do very well as a firm, or else we wouldn't be one of the longest lasting trading firms on Wall Street, you get to keep the majority of what you earn when the market does something unexpected. And that's key, right? I know capital preservation is a huge priority for most people, as it should be, and especially for those of you who are retired and no longer have an external flow of income. And this kind of trading is literally perfect for that. Okay, so if up until now all that you've done is invest in stocks and mutual funds and bonds, or if you've tried to trade them more actively for some short-term swings, you are going to be absolutely delighted when you discover what options income trading can do. Okay, no more sitting through massive drawdowns as the market takes a dive, and no more getting whipsawed left and right and making one wrong prediction after the other. Okay, and if you've actively traded other instruments like futures and forex and even options by taking directional bets, which is different than what we're going to be teaching you, then you're not going to believe how much easier it is to become an options income trader. Okay, no more getting whipsawed out of a position only to watch the market do exactly what you thought it would, and then being left to sit in utter turmoil and frustration. Okay, and I'm sure you've experienced that many a time. No more making consistent money in one market environment only to blow up your entire account when direction or volatility suddenly changes. Okay, I know that's a problem for so many traders and investors. No more having to predict price action and consistently get it right, which, believe me, almost no one can, even the pros. Okay, and no more beating yourself up about why you exited a position too early or too late, or what piece of market information you read incorrectly, or indicator gave you a false signal, or what tip was real or just BS. None of that. All those things become irrelevant. Okay, so any way you look at it, your life is about to become much easier, and your dreams of making money from the markets, whether through short-term trading or longer-term investing, just got much more possible. Okay. And best of all, other than the consistent profitability and the safety and low risk nature of it, and the relative ease of psychological execution, which is huge, this type of trading and investing requires very little time expenditure. It takes literally 10 or 15 minutes or less a day. That's it. Which means that if you have a full-time job and a family, and a full schedule because of that, you don't have to change anything. You don't have to dedicate hours in front of the screens, and you don't have to be waking up in the middle of the night to check the markets. Okay. And if you already trade actively, you can easily add it to your trading without spending more than a few minutes a day. That's why, the majority of our options trading desk can trade from a remote basis. They can literally trade our capital and be professional traders trading from their homes with their family. That's why most of the traders that you saw in our firm are the hardcore active day traders. Now, there are some options traders there too that choose to trade in our offices, but others don't need to. That's how unique this style of trading is. Okay. But now, having said that, what you do need is the initial effort and commitment to learn how to do this. Okay, it's not rocket science, but it's also not a get rich quick scheme, as I'm sure you're starting to realize. Okay, we are a professional trading firm with sophisticated strategies that stand the test of time. So, obviously, there is some dedication that's needed to learning to use our trading investment strategies. However, due to the nature of most of the income strategies that we teach, almost anyone can learn how to trade them if they put in some initial time and effort. Okay, but since you are here attending this workshop, I'm going to assume that you already understand this and that you are not in search of the elusive holy grail that makes you a millionaire without any effort or commitment to real learning on your part. You know that there's, no free lunch, nothing ever worth doing comes just like that, and you've experienced that in your profession, I'm sure, and there's, a certain truth to that. Even when it comes to this systematic rule-based trading, you got to actually initially learn it and dedicate yourself to it. But relative to, all other types of trading, you can learn it in literally a fraction of the time, and you don't have to have some innate trading talent or anything like that to do it, and that's the beauty of it. Okay. And as for the specifics of what we will be teaching you in this workshop, we'll start out with an explanation of how options income trading works. Okay, for those of you who are newer to options, and this will even be helpful for those of you who already know options. Then we'll teach you a trick of the trade, which is an options technique you can use to make money while you wait to buy stocks to build your portfolio if you invest in stocks. And this is actually something that's so incredible that Warren Buffett uses a strategy. Imagine literally getting paid just to wait to buy the stocks to build your portfolio. So it's very, very cool. And it's something that the big boys actually use very regularly. All right. And then we are going to teach you a specific kind of options income strategy that we like, and we're going to teach you exactly how to set it up so as to have at least an 80% probability of profit regardless of what the market environment is. So up, down, sideways, you make money in the majority of market situations. Okay. And so you'll get the specific rules of that, and believe me, I don't have to tell you how transformative it would be to your portfolio or trading account to make money in most scenarios regardless of what the market does. Okay. And then for the times that you do have a strong directional opinion for whatever reason on a stock or the market as a whole, and if you want to take a bet on that, we're going to teach you a much safer strategy for playing your directional opinion instead of outright buying the shares. Okay. And so this ends up allowing you to make money even if you're outright wrong on the stock's direction. Okay. So it's not only safer to do, but you could be completely wrong and still make money. So that is huge, obviously. And so you know that when you buy a stock or you buy the market, an ETF or whatever, it better go up or you're going to lose money, right? Or if you short it, it better go down or you're going to lose money. There's no other possible outcome. But when employing this strategy that we're going to be teaching you, believe it or not, you will still make your profit target if the stock goes up, if it doesn't move at all, and even if it goes down 5 or 6%. Imagine you are going basically long, you're bullish, and it can go down 5 or 6%. It could be completely the opposite of what you thought, and you could still make your full profit target. So you can be pretty wrong and still do incredibly well. And we're going to prove this to you with a real world example. And this is kind of like where options income trading really, really shines. Okay. And all of this will be taught to you directly by our head of options trading, which I'll introduce here in just a moment. Okay. But just right before we jump into all that, I do want to take a moment and highlight who this workshop is for, just so you're very clear if this is for you. Okay, so who is this workshop for? If you are retired and you are looking to make investment income on your portfolio so you can supplement your retirement income, which is, obviously when you get to retirement, sometimes your income is taking a dive, so you want to supplement it, of course, while preserving your capital base first and foremost. The strategies that you'll learn today can be more than perfect. Okay, instead of investing in mutual funds and hoping that the market does well, you are going to be learning strategies that can make great income regardless of what the market does, like I mentioned. Okay, not to mention that when you invest in the markets through mutual funds and the like, your average yearly returns end up being like maybe 7 or 8% over the long run. And worse yet, you end up having to sit through some horrendous drawdowns where you can lose half your account, half your portfolio, like many investors did in the 2008 meltdown and other comparable ones. Now, can you imagine what it would be like to watch half of your savings that you worked so hard for years just literally evaporate? Well, I mean, if you lived through the '08 debacle, you may just know exactly what that feels like, unfortunately. And the end of all of it is you end up averaging low single digit returns. You take all that risk for what? All right. But with the strategies that we'll be teaching you today, you can make multiple times that much in returns with much less risk and vastly, vastly smaller drawdowns. It's literally a whole different world of trading. Okay. Next, if you are someone who has a full time job and wants to have a healthy side income, this is perfect for you. Not only are the strategies built for income generation, but they require such a small amount of time to run that you can easily use them even with a hectic full time job. And of course, the same thing cannot be said for most other types of trading, which require a lot of time. So, this is really a huge benefit. And then if you're someone who already trades actively, maybe you trade stocks or futures or forex or whatever it is, and you want to add a powerful income generation aspect to your strategies, something more consistent that provides kind of regular income, this is the perfect fit. Because with the systematic rules, it makes it much easier to trade than probably what you currently do. And the tiny time requirement means you can just add it to your toolkit without really having any issue at all with that. Okay, so regardless of where you fall on the spectrum, options income trading can do wonders for you, and you are going to be learning the ins and outs of it right about now on this workshop. And as we are about to jump into it, I want to do something for you guys, and it's because I know what we have to teach is so important. I want you to stick around. And so I want to give you an end of workshop special bonus for everyone who does stick around to the very end of the workshop in an engaged state. And so this bonus is a video in which our head options trader teaches you a unique option strategy that he personally developed, which can make up to a 24% return on capital in only 2 months. Okay. Now that compares to an average long-term return of less than 2% in the stock market over a similar period. And that's average. It could be a lot worse than that. Okay. So if you stick around to the end of the workshop, you are going to get this strategy for free, and you will learn how to make up to a 24% return on your capital in just 60 days when the conditions are right. And you'll learn what conditions to look out for to put on this type of trade. Okay, and with that said, let me now introduce you to SMB Capital's head of options trading, Seth Freudberg.
Well, thanks for that kind introduction, and welcome everyone to our special options trading workshop. I'm going to be starting the workshop with a brief intro to options for those of you who are new to them. And for those of you who are already familiar with options, don't worry, this is going to be brief, and then we'll get into the exciting strategies that brought you here in the first place. So let's jump in. So there are two basic kinds of options: call options and put options. And while options are traded on lots of different kinds of assets, we're going to be focusing today on stock options and index options. So what are call options on stocks? A call option is basically a bet. The buyer of the call option is making a bet that the stock is going to go up beyond a certain price, which is known as the strike price of that option. For that bet, he pays what's called a premium equal to 100 times the price of the option. The call seller is the one taking that bet and receiving that premium. Now, if the call buyer is right, he's entitled to buy 100 shares of the stock at the strike price of the option, even if the stock has moved much higher than that price. If the call buyer is wrong, the call seller pockets the premium that the buyer paid him for taking that bet. So let's take a look at an example of a call option on a stock that's trading at 166. Incidentally, this is a real stock and this is real historical data, but we've intentionally left the name of the stock out so that you don't focus on this particular stock. Instead, we want you to understand the principles that we're teaching you here, which once learned can be applied to all stocks. So let's say a trader believes the stock will rally. He might decide to buy the 170 call, which expires on November 16th. The premium for that call, you'll see, is $2.78. But remember, he pays 100 times that price, or $278, for the right to buy 100 shares of that stock at 170, regardless of how high it goes. If the stock rallies to, say, 180, then he can exercise his call option, buy the shares for 170, and then turn around and sell them immediately for the market price of $180, making $10 on each of his 100 shares for a gain of $1,000 on those shares. On the other hand, if the stock sells off to, say, 160, then on November 16th, the option seller, the one who took the risk, gets to simply pocket the $278 premium he received for the call buyer's bet. In other words, that option expires worthless. So why is it worthless? Well, if you have an option to buy 100 shares of stock at 170, but the stock is trading for 160, who's going to exercise that option to pay $10 more than anyone else has to pay for the same shares? Obviously no one, so the option has no value, and the option's price closes at zero on expiration day. Now, a put option on a stock is basically the opposite bet. The buyer of the put option pays a premium equal to 100 times the price of the option to the put seller, making a bet that the stock will go down below the strike price of the put option. The put seller is the one taking that bet. In the case of a put, if the put buyer is right, he gets to sell 100 shares of the stock at the strike price of the option, even if the stock has moved much lower than that strike price. If the put buyer is wrong, the call seller pockets the premium that the buyer paid him for taking that bet in the first place. So here's an example of a stock trading at around 140. Suppose a trader owns 100 shares of this stock and wants to buy protection for those shares so that if the stock goes down below 135 before December 21st, he can sell those shares for 135 no matter how low the stock goes. Well, then he could buy the 135 put for, in this case, $209, which is the $2.09 options premium times 100, representing his 100 shares. If the stock drops to, say, 120, then he can exercise his put and sell the shares for 135, which is 15 points more than they're worth on the open market. So he makes $1,500, $15 for each of his 100 shares in that transaction. On the other hand, if the stock rallies and closes at 150 on December 21st, then the one who took the bet, the put seller, gets to just pocket that premium because the 135 option again expires worthless. Why? Well, who would want the right to sell shares at 135 when in the open market he can get $150 for those shares? Obviously, no one, so the option has no value and it expires worthless. So another way that calls and puts are classified is by whether they're out of the money, at the money, or in the money. Calls that are out of the money have strike prices above the price of the stock. Calls that are at the money have a strike price at or very close to the stock's price. Calls that are in the money have a strike price that's actually below the market. So this matters because where an option strike price is in relation to the stock's market price has a lot to do with the price of the option. So for example, let's take a look at this stock trading at $14.91. The 1530 call is trading for $3.41. That call's out of the money because it's above the price of the stock by, in this case, more than 40 points. For that call to have any value when it expires, the stock has to rally more than 40 points. Otherwise, it would expire worthless, as we discussed before. Now, the 1490 call is very close to the market price of 1491, so that's an at-the-money option. Now, all the stock has to do is go up a little bit, and the seller of this call is going to lose his bet and have to sell his shares below the market. So he's going to obviously have to charge a lot more for that risk. In this case, $17.26, which is about 5 times the price for that out-of-the-money option at 1530. Now, the 1450 call, that's below the market by 40 points and therefore is in the money. The buyer of that call could literally turn around and exercise that call immediately and require the seller to sell him the shares at 1450, even though they are worth around 1490. Well, the seller better charge at least $40 for that call because he could take a $40 hit immediately after selling it. But in fact, he charges more than $40 to absorb the risk that the stock rallies and his loss would be even larger. So the in the money option in this case is more than 13 times as expensive as the out of the money call and 2.5 times more expensive than the at the money call. So out of the money options are the cheapest, at the money options are more expensive, and in the money options are the most expensive. By the way, for puts, everything's reversed. The puts below the market are out of the money and cheapest. The puts at the market price are called at the money, and the puts above the market are actually the in the money options in the case of puts, and they're going to be the most expensive as well. Now, another use of options is to take bets on indexes such as the S&P 500 or the Dow Jones. Like with stock options, a call option on an index is basically a bet on the entire index. The buyer of the index call option pays a premium, again 100 times the option's price, for a bet that pays off if the index gets beyond the strike price of the call. The call seller is the one who takes that bet. If the call buyer's right, he gets a payment of $100 for every point that the index exceeds the call strike price on expiration day. If he's wrong, the seller pockets the premium, just like with stock options. The buyer of an index put option gets a payment of $100 for every point the index is below the put's strike price on the day it expires. If the put buyer's wrong, the seller, again, pockets his premium. So let's take a look at this index trading at 1439. You can see here that the 1500 call, which expires in February, 67 days from now, has a price of $31.50. So he has to pay 100 times that, or $3,150. If the index rallies to beyond 1500 by expiration day, say to 1520, then the option seller will have to pay the owner of that call $100 for each point above 1500. In other words, the seller owes the buyer $2,000. If, on the other hand, the index sells off to 1400, then the call option has no value. The call seller owes nothing to the call buyer, and therefore the call expires worthless, and the call seller pockets $3,150 that he was originally paid. Now, in that example I just gave you, you might have noticed something interesting. In the case when the market rallies to 1520, the call buyer gets paid $2,000, but remember, he paid $3,150 for the call. So he actually lost $1,150 by buying that call. So that brings up a crucial principle for you to remember. If you buy an index option, you won't make any money until the price of the option exceeds the strike price by the amount of the premium you paid for the option. So in that last example for the index trading at 1439, if you buy the $1,500 call, 1500 call for $31.50, then you won't make any money until the index hits 1531.50, which is the 1500 strike price plus the 3150 call price. So the seller, the one taking the bet, makes money at any price below 1531.50. The call buyer, on the other hand, must be right by enough to cover the premium that he paid in order to make any money on the trade at all. So ironically, you can be right about the market's direction and still lose money on a long option. When you're long an option, it's not enough to be right about the market's direction. You need to be right by enough to cover the original options premium that you paid. So you can be right about the market's direction and still lose money. Conversely, the call seller can be very wrong about the direction of the market and still make money. It's amazing if you think about it. So in this example, let's take a hard look at just how high of a hurdle this is for the call buyer to make any money. If the market rallies to 1531.50, then the call is worth $3,150. That's $31.50 times 100, or $3,150. But we paid $3,150 for the call in the first place. So the call is worth $3,150, but it cost us $3,150 originally, so we make nothing on the call, even though the market rally 90 points. But think about the call seller. He makes money on any price below 1531.50. So that means the market can rally 89 points and he still makes money, even though he took the other side of your bet that the market will go up. So the true edge in options trading is actually in selling options, not buying them. Think about it. There are only 5 possible outcomes for each options trade. The index or stock rallies a lot. The index or stock rallies a little. The index or stock doesn't move at all. The index or stock goes down a little. The index or stock goes down a lot. Those are the only 5 possible scenarios. So for example, if you buy an at-the-money option, you actually lose in 4 out of the 5 cases. For example, if you buy an at-the-money call option for an index trading at 1900 for $40, so it would cost you $4,000, then if the index goes down a lot, you obviously lose. If the index goes down a little, you lose. If the index doesn't move at all, you lose. If the index goes up $39.99, you lose because you didn't cover the cost of the call. Only if the index rallies more than $40, the cost of the call, only in that one case do you win. But if you're the call seller who's on the other side of that deal, if the index goes down a lot, you obviously win. If the index goes down a little, you win. If the index doesn't move at all, you win. If the index goes up $39.99, you win. Only if the index rallies more than $40, only in that one case do you lose. You see, what most people don't think about is that on expiration day, every single option that is out of the money expires at 0. In fact, studies have shown that 75% of all traded options expire worthless. So don't you think on balance, it's better to be short options where you're the seller, constantly pocketing the premiums you collected for options, 75% of which expire worthless. So with that knowledge, I think it should be easy for you to see that the purpose of this workshop is to teach you how to become essentially an options premium seller, which is the smart place to be in options trading. So now that we've covered the basics of options, let's jump into an option strategy that the most sophisticated investors in the world use to enter into investments at the optimal time. It's called the cash secured put strategy, and it's one of Warren Buffett's favorites. Now, suppose that a stock you like to buy has just rallied and you missed the rally. Are you stuck buying that stock at the inflated price and then risking the stock selling off a little bit, in which case you got sucked into buying at the top when you really wanted to buy at the bottom? With the cash secured put strategy, you can completely avoid that frustrating situation and instead learn how to actually profit from those situations. So let me show you how. With the cash secured puts technique, you decide your entry price and wait for the market to come to you. So let's say, for example, that you want to own 1,000 shares of a stock, but the most you're willing to pay is $150 for those shares, yet those shares are trading above that price. Let's see what happens if instead of breaking your discipline and chasing the market up, you instead sell the 150 strike puts of this particular stock approximately every 30 days until you're assigned the shares by the buyer of the put. So in this case, you're the person obligated to buy the shares at 150 whenever that happens because you are the put seller. But remember, you want to own those shares at 150. So while it's your obligation, you'll be happy to come through on that obligation and buy a stock that you want at your price. So here's the stock on this day trading at 153.11, which is $3.11 more than we're willing to pay. So instead of paying up for the stock, we go out about a month and sell 10 of the July 28th 150 puts for $1.53. Well, that means we'd receive cash from the put buyer of 100 times the price of the option. So 153 times 10, because we sold 10 of these puts. So we receive a total of $1,530 for selling the 10 puts. Well, as it turns out, on the day the option expired, the stock closed at 155.81. So the option expired worthless, and we pocket the $1,530 in cash. So once that option expires, and we're now $1,530 richer, by the way, we just do it all over again. In month 2, we go out 26 days and sell 10 of the 150 puts. This time we're bringing in $660 in cash because the stock's moved up, but our entry price hasn't changed. We want this stock at 150. If you think about it, all we're doing is putting in a bid basically for a stock we're happy to own anyway at 150. We're basically getting paid to bid on a stock. Well, on August 25th, the stock closes at 159.89. So our August 25th 150 put expires worthless, and we just pocket the $660 in cash. Now in 2 months, we've received over $2,000 in cash simply for putting in a bid on a stock that we wanted to own anyway. So in this actual historical example, we keep doing this month after month until the stock finally sells down to 150 in May of the next year, 8 months later. So had you done the same thing every one of those months, selling the 150 put about a month out and letting it expire worthless, look what would have happened. In month 1, you would have pocketed $1,530. In month 2, $660. In month 3, $440. In month 4, $1,910. In month 5, $300. In month 6, $300. In month 7, $200. And in month 8, $720. Finally, in month 9, the stock drops to below 150, and the put buyer assigned the shares to you at a price of 150, the price you were waiting for all along. And while you waited, you collected a total of $6,060 of put premium. Incidentally, 8 months later, in this actual example, the stock traded up to 174.88. So now your shares are worth $174,880, plus the $6,060 you made selling the cash secured puts, yet you only laid down $150,000 for the shares, providing you with a profit of $30,940 in 8 months, or a return of 20.62% because you were disciplined. You didn't chase the price, and you got paid to bid for the stock at your price. So I ask you this: why just enter an order to buy a stock below the market when you can get paid to wait? Selling cash secured puts like Warren Buffett does keeps you disciplined as a trader while paying you to wait for the market to come to you. In this real life example, not only did you get your price, but you were paid over $6,000 in put premium while you waited, bumping your overall return 4% simply by building your portfolio the right way through a simple program of cash secured puts. Now, let's take a look at another one of my favorite strategies, the Iron Condor. Let me ask you this: what does a trader do if he's really bad at picking market direction? Most independent traders and many professional traders are notoriously bad at picking direction on individual stocks or the market as a whole. They get confused by the talking heads on CNBC, by well-meaning friends, and frankly, their own emotions. That's why most day and swing traders end up failing and quitting in frustration. Well, what if there was a trading style that didn't require any prediction about market direction? There is, and it's called options income trading. In options income trading, we don't really care what direction a stock or the entire market takes. As long as the market trades into a range above and below the current level, we'll make money. How wide of a range? Well, to answer that question, I want to share with you one of the most effective and profitable strategies employed by professional options income traders. And once you learn this strategy, a whole new world of high probability trading will open up to you. With iron condors, you don't need to guess market direction anymore. Do you think it would be possible to make a 17% return on your capital in 50 days on an equity options trade without having any idea what direction that stock is going in over that 50-day period? And suppose that I told you that you would make your 17% return at any point within a 120-point range above and below the current price of a $670 stock. So let's see if that's possible. So iron condors are put together by selling what is called a credit spread far out of the money with what is called a put spread also far out of the money. So let's take a look at an example and this will come clear to you. Here we've got a stock trading at 673.20. Now, if we go out 50 days in this case to December 16th and go all the way down and sell the 610 put, we'd collect a premium of $303. If we then go in and buy the 600 put for $238 as protection, then we still have some change left over from selling the 610 put because it was more expensive than the one we bought at 600. So this combination of selling and buying puts is called a put credit spread because we sold a put closer to the money and collected more money for that than we paid for our protection by buying the 600 put and paying less money because that put is farther away from the market. Now we call this transaction the selling of a put credit spread because even though we're selling and buying an option at the same time, we're getting more money for the option we sold than the option we bought. So we're receiving money for doing this, and thus we're selling that spread. So in this example, since we sold 10 of these puts credit spreads, we received a total premium of $643. We were paid $3,030 for the puts we sold, and then we turned around and paid out $2,380 for the puts we bought as protection, leaving us with $653 after commission. Now, at the same time as we do that, we sell a call credit spread where you go all the way up to the 730 strike and sell a call closer to the stock price. Then the protective call you buy farther from the stock price, again, collecting a $793 credit because the calls we sold were more expensive than the calls we bought. So we took in $793 of cash from the call credit spread. So when we combine these together, the call credit spread way above the market and the put credit spread way below the market, that combination is what is called an iron condor, a short call and a short put closer to the market and a long put and a long call farther from the market. In this case, we total up the credit from both spreads for a total credit of $1,435 in this particular case. So just as we did with the put credit spread, we sell the 730 call for $2.38, netting us $2,380 for our 10 calls. And we buy the 740 call for $1.58, netting us $1,580 for our 10 long calls. With commissions, we net out $793 for the call credit spread. Adding in the credit we already got from the put credit spread, we receive the total credit of $1,435. That's how it breaks down. Now, for this iron condor, about $8,500 of capital would be required by your broker. And you received $1,435 for the iron condor at the beginning of the trade, as we mentioned. So if you do the math, that's a return of 17% on your capital, as long as the market stays within the 120-point range over a 50-day period. Well, it turns out that there's an 82% statistical probability of that being the case on day 50 of this trade, the day that the trade expires. That makes sense because 120 points is a pretty wide range on a $673 stock. That 120 point range is called the profit zone, and it's depicted by the flat, wide $1,435 profit zone above the $0 profit line on this illustration. We use these kinds of illustrations in options trading to make it easy to see the zone of prices on expiration day over which the trader would make a profit depending on the strategy that he's employing and how much profit he'd make at different points within that zone. So let's just see how improbable it is using common sense that we would lose money on this trade. For us to lose on this trade, this stock would have to exceed its all-time highs or drop to a price that was last seen over 6 months ago. And it has to do that over the next 50 days. So in summary, as long as the market stays between 610 and 730 over the next 50 days, we pocket a 17% return at any closing price between those two numbers. Now, in this real life example, on the final day of the trade, the stock closed at 641.25, over 30 points above the put spread and almost 90 points below the call spread. So let's break down what happened to each of the options on that day. So on options expiration day, the stock closes at 641.25. The 740 call expires worthless because the stock's trading 90 points below that. No one is going to exercise a call for 740 when he could buy the shares in the open market for $90 less per share. The same is true, obviously, for the 730 call. Now, on the put side, the 610 put also expires worthless. Why? Who would exercise a right to sell his shares for 610 when he could get $641.25 for them in the open market? So this right obviously has no value, and the same for the 600 put below that. So both the call spread and the put spread expire worthless. All four options of the Condor had no value on that day. So we get to keep the full $1,435 credit, a 70% return in 50 days, which shouldn't surprise us given the fact that there was an 82% chance of that happening in the first place. Now, one thing I'd like to point out is that not once, if you notice during my explanation of this trade, did I ask or even care which direction this stock was going. I didn't have to try to outguess the market and all of the brilliant minds on Wall Street who know 100 times more than you or I do about the likely direction of a stock. Trust me, for many reasons, it's going to be very difficult for you to outsmart the professional money managers. But what you absolutely can do is to employ strategies like the Iron Condor to give you outstanding returns without having to make a bet about the likely direction of a stock, a bet which, let's face it, most of us get wrong most of the time. The Iron Condor is an incredibly powerful technique for capturing profits in the options market, as you can see from this simple example. Now, in the example I just showed you, where we went over the power of Iron Condors, I'm guessing that some of you were wondering, well, what would happen if the market did, in fact, move outside of the profit zone, as happens in some cases, obviously. You might be wondering if we're just sitting ducks at that point and have to simply lose the trade. And the good news is that is absolutely not what has to happen at all. That's because options trading is extremely flexible, and the positions that we set up initially can be modified. These modifications are called trade adjustments, where we make changes to the initial trade to widen the profit zone. So let's take a look. This is a historical example of an index that was trading at 2622 on this particular day. Let's say that we decide to construct a 450 point wide Iron Condor 58 days from expiration with a call spread where the short call is at 28.50 and the long call protection is at 28.75. So that's a 28.50, 28.75 call credit spread. On the put side, we would sell the 2400 put and buy the 23.75 put. Remember, since the options we're selling are closer to the money than the protective options we're buying, we receive more cash for selling the short options than we're paying out for the long options, resulting in a net cash credit into our account. In this case, that credit is $4,385 net of commissions. If you do the math of all the cash we receive for the options we sell and the payments we need to make for the options that we buy. So again, let's look at the initial setup of this condor. If on expiration day, the market closed anywhere within that wide 450 point range in the market, then all four of those options, the short ones and the long ones, would expire worthless. And we just pocket the $4,385 we got at the start of the trade, just as we did in the last example. If, on the other hand, the market closes below 2,400, 200 points below the current market, then the trade loses money. Or if the market rallies past the 2850 strike, 250 points above the market, then the trade would also lose money. So as you can see, on expiration day, at any price between 2,400 and 2,850, we would earn the full $4,385 credit that we originally collected for selling this index iron condor. Otherwise, we would take a loss. Incidentally, that would be a 21% return on the capital that you had risked in this trade, nearly 3 times the annual return expected in the long run through simply owning General